I'm going to show you how I made $600 and how you too could potentially do the same thing. Let's go. Okay, so this is a quick trade from NQ. We're going to break it down. We're going to do a naked chart. We're going to be no longer than 10, 15 minutes tops. So if we are approaching the market, this is fresh. Of course, now we have the ability of hindsight. But if we're approaching the market fresh, this morning I woke up, I want to say around 6:45 PST time. And typically the market has already done its movement. So let's go to the time that I woke up. So as we can see here at 6:45 when I'm approaching the charts, the market is already within its move. So we open and we immediately opened higher. Now I'm going to be real with you. Let's go to the daily time frame and let me show you where we are within the daily. I ultimately didn't have a bias on where we would open up and go for the day due to just this back and forth of consolidation within this range here. So we haven't broken out of this range completely. So if we're doing a 20-day look back, this would be the high, this would be the low within our 20-day look back period. So I'll take it from here, grading the range within our 20-day look back period. So you see how we've just been in this consolidation period, just trading back and forth, back and forth, back and forth. So originally didn't have a bias for the morning. And then typically, again, I woke up late. I'm normally up around 5 in the morning, 6 o'clock the latest. That way I am getting my analysis done beforehand. Now, this is where FOMO comes into play. Let's go back. The move has already taken off without me. Let's go back to the time frame of where we are this morning. Here, this is where we are. So the move is already taken off without me. Essentially, I don't want to see higher price action, meaning I don't want to take this move higher because I've already missed the accumulation of the move. So you have this first leg of accumulation here, second leg of accumulation, and so on until we got to here for the day. Now, okay, Alex, what do we do? What do we do when we've already missed the move? We sit on our hands. So we typically wait for the first hour of trading. So what we're going to do is we're going to grade the highest high to the lowest low from 9:30, which is here. This is the lowest low, our opening, 9:30 to 10:30, which is right here. So this was the highest high. This was the lowest low from the first hour of trading. So what we'll do here is we'll take our box. We'll draw from this portion. So now we have just what? We have defined our range. Now we're going to grade the price range from here, the lowest low, to the highest high within the first hour. So this is where we are. So now we're allowing the trade to play out. For me, again, I personally don't want to take this trade higher, chase the move. So what form of retracement could we find in the market? I didn't believe that the market would go all the way back down here to the lowest low. And we have, again, low here. Then we have a high, higher low, which is right here. We go up again, our low, our high. Now we have a swing point. What defines our swing point? These swing points are right here. The lowest candle in between these two candles here, swing point, You have a small swing point here, and then you have this swing point here to here. So now we're in the upper portion of the market. This is where we are. We're in the upper portion of the market. So we're not even worried about the lower half. Now let's just find the nearest liquidity within the upper portion of our dealing range. So again, we have here, here, and I missed this swing point here. We have also a swing point here. Now, do we expect the market to get all the way back here to 10 o'clock? Absolutely not. I'm not expecting to get back to the equilibrium of this range. So I'm not even focused on that. What is the lowest hanging fruit? I'm teaching us to get the lowest hanging fruit possible of a move. This right here would be the low hanging fruit, right? And we're in a a buyer a buyer's market maker model here is what we have right in here. So I'm looking for, we failed to take out this high here. The market is essentially tipping its hand to you here. So we waited. We took out some short term here, Price came. Again, teased the left these relatively equal highs here. So now we have what we call a change in the state of delivery right here. This is going to be your order block. These three up close candles, because we have changed in the state of delivery here. So the price sensitivity is going to be on this opening candle here. So that's our order block, bullish order block here. Liquidity. So what we have here, our sell side liquidity. This is, again, low hanging fruit. You don't have to worry about it getting all the way back down to here, because not only do we have relatively equal lows here, but we also have an inefficiency. This is our buy side imbalance, sell side inefficiency is what we have. So now that we defined our range, let me go ahead and take off of this box here, and let's draw our inefficiencies. Have an inefficiency right in here. That's going to be our, again, our buy side imbalance, sell side inefficiency, our BISI. So now, again, we have this order block, this change in the state of delivery. Now we also have what we call the inversion fair value gap. This is a buy side imbalance, sell side inefficiency. But when price is trading through it, we want to see the bodies respect here. It can wick into this area, but we don't want to see bodies close in the upper half, because now it's reversed its role. And so this is now our inversion fair value gap. Here, coupled with this order block, bearish order, or bullish order block, excuse me. Price comes, trades through. My entry was here. I don't have my executions on. I have to log into my broker, but I don't have my executions on. So my entry is here. I got in as the candle closed, got in right here. It gave you 3 opportunities to get in here with your bullish order block. So from here, take our short position. Where will we place our stop now that we define the risk? I'm going to place my stop, just to be safe, right here at these smooth, relatively equal highs. Got out of the trade right here. So this is a 70-point trade. This is a bread and butter setup. If you were attempting to chase the market to this swing low or this swing low, you would eventually got stopped out of this trade here. So our confluences were there. Look how price respects this buy side imbalance, sell side inefficiency. When we are in an overall uptrend, you want to see the upper half respect it. You don't want to see any bodies of the candle close in this area, and it eventually goes on, takes out these relatively equal highs here, and then giving up the ghost again, and then taking out these smooth, relatively equal highs here. But these setups exist in the market all day, every day. Again, I don't have to chase the move higher, even though I could have still been a part of the move here, could have got in and took it to here. But what did I explain in the previous video? If you haven't watched the previous video of the time theory, in that video, I break down the market, or the algorithm goes from premium to discount back to the premium, is essentially where we're getting at. Where is my, here it is. So we're here, back into the premium, into discount pricing. Now we have left discount pricing back into the premium. You could have taken this small little discount back into the premium, consolidating, consolidating, consolidating in the premium, back into a discount. We take out this swing point here, price consolidates and goes what? Back into the premium. So now you understand what the algorithm is seeking. The market tips its hand to you. It failed to take out these relatively equal highs, change in the state of delivery here with your inversion fair value gap slash your bullish order block. It's tipping its hand to you. And again, this is a low hanging fruit objective. You don't have to have a massive amount of a move to make money. This move was exactly to the T, $600 even. And these setups exist all throughout the market. So there was no need to have FOMO. Let me show you. There was no need to have FOMO at 9:30 or 9:45. I'm already asleep. There's no point of chasing it. Let the market do its thing. The market rose 200 plus points at the time that I'm already getting into the market, meaning getting in front of my screen. So the market had already rose. Let's do it again, from 9:30 to 10:30, 370 points. There's no point of chasing the move because it's already went without you. But you assess, I had no previous bias coming to the chart. You assess the range, the current dealing range that you're trading in, and then you go from there and you form a bias from there. So woke up, the market had already moved, wait for it to move, finish its movement, and then seek areas of obvious liquidity, of high probability and inefficiencies, and just target the move. I didn't need the whole $371 move. Would it have been nice? Absolutely. But there are 250 trading days in a year. Typically 20 trading days in a month. $600 for the day, that's groceries for the month, gas for the month, a light bill. So I'm not teaching you to be, let's be astronomically rich and let's live the Lamborghini lifestyle. Maybe you don't have the risk tolerance to do so, but I'm showing you what is possible of making your ends meet. An extra $600. Do you know most marriages in the state of California and the United States in general in divorce because couples didn't have an extra $500 in their bank account or in their savings? So $600 goes a long way depending on how you see it. So this has been our trading breakdown for the NASDAQ indices or index futures. And until I talk to you next, video, Lord willing. Grace and peace, family.